Have you ever been watching the financial news one day, especially lately, and you hear a story that in some places in the world, interest rates are actually negative? If that is interesting to you, stay tuned. I've been following the markets since the early to mid 1990s. So I saw the whole .com boom and bust happen. Then I saw how the economy and the stock market reacted to 9/11. I went through the whole housing meltdown and watched all that unfold. Then I watched the government start to do things that they said that they would never ever do, a thing called quantitative easing and trying to stimulate the economy. Well, now we are dealing with a situation, not in the US, but in other markets, where interest rates have actually turned negative. Now, in Japan, we had interest rates go negative a while back. But in Germany right now, interest rates are negative and have been negative for quite a while. And you have to wonder, why? What does that have to do with anything? Think about it this way. If you go to a friend and you want to borrow money, let's say you borrow $1,000. Well, not only are you expected to pay that $1,000 back, but you're going to have to probably pay interest on top of that, maybe 10%. So let's say after 1 year, you end up paying that friend back not only the $1,000 that you borrowed, but $100 extra for being allowed to use that money. That only makes sense. And that's what I've seen pretty much in my whole lifetime. If you go to the bank and borrow money, you have an interest rate. If you get a mortgage, you have an interest rate. If you buy a car, anytime you pay for something over an extended period of time, not only do you have to pay what you owe, but there's going to be additional interest on top of that. So why in the world are interest rates actually turning negative? And where in the world is this actually happening? So I'm going to switch over and look at some charts just to show you. So looking here at my desktop, what you see in front of you are the yield or the interest rate values for all of the different government bonds in the US. This black line at the very top, this is the 30-year bond. And right now, as the time I record this, we are at about just a little bit over 2%. Now, I don't know about you, but when I was growing up and we had little finance classes or lessons where we could learn things, we used to say, okay, take some money and put it in a savings account in the bank and just figure on 5%. That was kind of the going value at that point. Well, this was also during the 1970s where we saw 20+% interest rates at that time. So to think that you're getting 5% on your money was not that crazy to think about. Now, my goodness, if you want to tie up your money for 30 years in an investment, you might be able to make about 2%. Now that's okay as long as inflation is even lower than that. You're at least staying lockstep with the inflation rate. But a lot of people get into these investments so that they can live off the interest. And the US is doing pretty well with this right now. The 30-year bond, as I said, is just a little bit over 2% at this point. Then we have the 10-year bond, and that's at about 1.3% over here on the right-hand side. Then you have the 5-year bond, which is about 0.57%. Okay, a little over 0.5%. Then you jump down, and if you want to tie up your money for 2 years, you're going to get 0.13%. And then you have 90-day T-bills, which are 3 months, and you're going to get about 0.04%. These numbers right here are getting quite close to negative. Now, they haven't gone negative yet, but they have it other places in the world. This is one of the reasons why the bond market has really been holding up well. There's a lot of reasons. There's the stimulus money that's being thrown into the market. Somebody just isn't sitting in Washington, D.C. or Fort Knox or wherever they make money. It's actually Washington, D.C. But they're not churning out the printing press. That's not how it works. It's really more of a digital thing that people do on computers. Well, to introduce this money into the markets, they usually put it into the bond market. And when you're buying bonds, what happens is as the bond prices go up, as people buy them, that makes the interest rates go down. But at least in the US, they've stayed positive. And so you have all these investors all over the world who are seeing either a much lower return for putting up their money, or they're even seeing negative interest rates. And so they come to the US and they buy the US bonds. They're buying the debt of the US government. And countries like China, Japan, a lot of hedge funds, they own a lot of this debt. And that's a real concern for some people, where both Japan and China own a lot of US debt. Well, our government has to pay that debt back. And what's going to happen if they can't? What are China and Japan going to do, and other countries? What's going to happen there? And we may be heading to some kind of a train wreck in the future. I believe personally that we are in a debt bubble right now. Now, some of you may disagree with that. You may fall under the umbrella of thinking that this new thing that you might have heard about called modern monetary policy or modern monetary theory, where the government debt doesn't matter. You can keep printing money, you can have as much debt as you want, and it really doesn't matter. Well, that goes against sound economic principles, but it's what America has been adopting over the last 20 to 30 years, and it's what they're going into high gear to adopt now with the new administration. So this is really pushing a lot of the debt to a point where it's going to have to be dealt with at some point. A lot of the student loan debt, they're saying, oh, we're just going to forgive that. Well, okay, that might mean that students don't have to pay that back, but somebody does, and that usually falls upon the people in America by higher taxes. So there's no free lunch. Somebody has to pay, just like with healthcare. Somebody has to pay for all of these benefits that we supposedly want. So, but getting back to our original argument, we can see that in the US anyway, interest rates have stayed positive for this point. They're low, they're historically low. And another concern that is really in the markets right now is with all this stimulus money being thrown into the markets, you see more and more dollars available. Well, every time a new dollar is created, that makes the dollar that you have worth less. Not worthless, worth less. And the more dollars that are out there, the more value the dollar that you have is going to lose its value to a point where you're going to start to see prices really go up. And we're seeing some of that start to happen now. And so a real big concern is inflation, where prices are going to go up, and that means interest rates are going to go up. And some people are saying that we might get back into a 1970s kind of situation where we have over 20% interest rates, and trying to get a mortgage, you're going to pay 25-30% for that mortgage, and it's really going to turn into a mess. I've even read some information from other people that say the 1970s are going to look like the good old days compared to what lies ahead. And as I say in some of my other videos, I pay attention to the people that are always positive, or perma bulls is what we call them. They're always looking at the bright side. And there's something to be said for that. Having a positive attitude, thinking the future is going to be better than things are right now. But then you have the other side who are perma bears, and they're just always ragging on the market, saying we're just about ready to fall off a cliff. Things are going to go right into the toilet, and the economy is just going to explode. We can see anywhere from a 50 to a 90% decline in the stock market in the future as the U.S. economy starts to recover potentially from the COVID-19 pandemic. because that just ruined the U.S. economy. How are we going to put things back together? Well, one alternative that you're hearing about is known as the Great Reset. And I'm doing a lot of research about that right now, and I'm going to be talking about that in other videos. So if that is something that interests you, I do cover those topics. Now, let's look at another chart here, where this is the Japanese 10-year bond yield. Okay, that means interest rate. And this was back in 2019. Ever since the 90s in Japan, their economy hasn't been doing all that well. They've tried all these different tricks, led by the Bank of Japan and supported by the Federal Reserve in the US and even European central banks. They've tried all these tricks, but it hasn't really helped Japan all that much as far as economically. They're not seeing the explosive growth or the opportunities in the economy in Japan that they once saw. But at the end of 2018 and into 2019, you can see here, I have this big red circle where interest rates actually dropped negative. This was the first time I'd ever seen this in my life. And other people that I know that are older, they've never seen anything like this before. The idea that, okay, you're going to loan money to somebody, and then let's say $1,000, and instead of them paying you interest, you're going to not only loan them money, but then pay them interest as well. You're going to pay for them coming to you and borrow money. That makes absolutely no sense. But it's what's happening. Our country would want to do this because they want their currency values to fluctuate, and they want to try to stimulate the economy. They're figuring, well, we can't tie up our money for 10 years in a 10-year Japanese bond. We're getting negative interest rates. Let's put that money somewhere else, where hopefully the things where they're putting that money will influence the economy to grow. Maybe they're going to put it into some kind of investments, or maybe they're going to go out and spend it in retail products that they buy. So that may help them that way. That's the idea behind this. But what you saw into 2019 and right into early 2020 were interest rates going largely negative in the 10-year bond in Japan. If you look way over on the right-hand side, currently they're back positive. Not very much. You're getting 0.07% interest. Okay, 0.07% of interest. So it's almost laughable. I did just laugh. So that's where things are just going kind of weird right now. So let's look at another country. And here, this is the 10-year Bund. That's how they say bond in German. That's about the only German word I know. That and Gesundheit and Strudel and Glockenspiel, things like that. But we're seeing this actually right now in Germany, where if we look back into 2016, in the summer of 2016, interest rates went negative, and you can see I have the smaller little red bubble right here. But then they went back positive. And everything seemed to be going fine, going good. And then down into 2019, they dropped into negative territory again, have been bouncing around below zero. That's what this green line is right here on the chart. That's below zero. And they have remained below zero up until the current time. And now, one reason is that the euro is really enjoying a lot of power right now, a lot of growth. It's considered to be a pretty good currency. And one of the reasons why they're dropping, at least in Germany, I think they went, in Scandinavia, they went negative too, but that's not a very big market, so I didn't bring up any charts of that. But they're hoping to bring down the value of the euro, especially against the US dollar. They want the dollar to be stronger and they want the euro to be weaker. So far, that hasn't happened. And the next chart I'm going to show you shows you exactly that. And so we have to also keep in mind the different currencies that we use. We have the US dollar in America. They have the euro that operates throughout the whole European Union. Then you have the British pound. They never did adopt the euro, even when they were part of the European Union. You have other currencies like the Swiss franc, where, yeah, you can use the euro there, but they kind of would like you to use Swiss francs instead. But the idea being that if you travel anywhere inside of the European Union, you can use euros. There's only one currency that you have to worry about. Well, when the euro first came out, it was a real flop. And they thought, oh, great, what have we done here? Well, over a period of time, and then 9/11 happening and the whole housing meltdown in 2008, and all the mess that's happened in the U.S., the euro has really, it's starting to stand the test of time and is becoming a fairly solid currency, so to speak. And they want that value to go down, and they want the value of the U.S. dollar to go up. And I have another chart of the dollar that I'll show you next. And so that's one of the reasons they might do this. Well, it hasn't really worked yet. In fact, the value of the U.S. dollar has gone down. So looking at this chart, this is a weekly chart of the U.S. dollar going back about 10 years, way over on the left. That's where this chart starts. And this is a weekly chart that we go all the way up until the present time, where I have this green line here, that's at 80. This is known as the US dollar index, and I follow this every single day. I even follow it during the day because I'm really watching different currencies. I don't even trade the foreign exchange market. I don't even teach about Forex, but I watch it all the time nonetheless. And you can see when we get down to about 80, as far as the U.S. dollar index is concerned, this is the U.S. dollar against a basket of other currencies, with the biggest one being the euro. It's also valued against the Japanese yen. They take all these currencies, put them all together, and then compare them to the value of the U.S. dollar. But in 2014 and into 2015, we saw a real increase in the value of the dollar index. And it stayed pretty good. It was right around 100, anywhere between 90 and 100. And then it started to shoot up above 100. And then as interest rates started to go negative, you can see right in this area that I'm circling, this is when interest rates went negative in Germany. And Germany is the biggest economy in the European Union. And you would think if their interest rates are negative and they're trying to bring down the euro, why isn't the dollar going up? Well, it didn't fall, but it didn't really go up very much either. Now, as another side note, U.S. companies, they like the dollar to be weak because big companies that do international business, they do the business in the currency of the country in which they do business. And so when they convert that from, let's say, euros into dollars, or from British pounds into dollars, or Japanese yen into dollars, they want the dollar to be weak because when they do that conversion, they get more dollars from that. And that looks good on their books, and they can use that as part of their accounting, and it shows that they made a little bit more profit than what they really made. So it's kind of a paper profit in that regard. So companies want the dollar to be weak. U.S. companies do. The government wants it to be at least stable, to the point where, because it's the world's currency, and anywhere you go, the dollar, at least anywhere that I've gone, the dollar, it may not be the main currency that you can use in a particular country, but it has value. And most business transactions are conducted not only in English, but also in dollars as well. But this is what's interesting is throughout 2020, we saw the value of the dollar pretty much fall by 10%. It was right around 100 as the pandemic started to really take hold and the U.S. economy was shutting down. We dropped from around 100 all the way down to 90, and we're at about the 90 level right now. And that we might be forming some kind of a base here, and we might see a little bit of a bounce. But at the same time, with all the stimulus that's being added to the markets, that's going to make each dollar that's out there worth less. So that could play into the scenario as well and really drive the value of the dollar down. There are people that, especially when we get down to this 80 mark, I remember back in 2012, 2013, the death of the dollar, it's going to die, it's going to go away. And Maybe at some point it will, but usually when you start hearing those cries, that's about the time when the dollar starts to recover. And then if we do get to the point where we drop down to 80 again at some point, death of the dollar, we're going to drop that. We're going to get the Amero, and we're going to have Canada, Mexico, and in the U.S., all Mex-Amera, Canada. We're going to combine into one country and have one currency. Now you have Bitcoin and all the different cryptocurrencies that are coming into play that are not backed by the banking system. The dollar is not backed by anything either. At least it's backed by the banking system, but it's not backed by gold. You can thank President Nixon for that. He took us off the gold standard back in, I think it was 73, when the value for every dollar that you had, there had to be some gold behind it. Well, now we have what's called a fiat currency, which means there's nothing behind it. It's just whatever it's worth according to what the market says it's worth. And if things really turn south in the US and with the dollar, you could see the dollar go away. I'm not quite at that point personally yet, but there's a lot of doom and gloomers out there that are and have been saying that pretty much for the last 10, 15 years, that things are going to go away. And I guess if they say this long enough, eventually they'll be right. But I don't really pay attention to them. I listen to what they're saying, but I don't necessarily put into practice what they're saying because I make my own decisions and I just use what I'm seeing to make decisions. Again, because interest rates are negative, they were negative in Japan and they are negative now in Germany, that's to help stimulate the economy. It's also, in a European sense, to help bring down the value of the euro, which hasn't happened. The top chart is the euro, and the bottom chart is US dollar, and these are almost mirror images. This is like looking at a mountain range on the top and then a reflection in a lake on the bottom. There is a real strong correlation between when the euro goes up, the dollar goes down, because those are kind of the two main currencies in the world right now. I hope you found this interesting, and I'm publishing lots of different videos. Please feel free to subscribe to my channel, leave any comments, send me a message. I have a public Facebook group that anybody can join. I post when I'm going to be uploading new videos, and you're welcome to check these out. So thank you very much.